Hello and welcome to another episode of Pakistonomy. My name is Uzair Yunus, and per usual, we would have talked about the IMF and what's going on in Pakistan, and there's obviously still a lot of economic uncertainty in the country, but there has been a lot of economic uncertainty here in the United States, where the Silicon Valley Bank has collapsed. There's conversations about a banking crisis. UBS and Credit Suisse and others are under pressure as well. And that reminded me that when my own economic education began, my education in economics began at Bentley University, Professor Aaron Jackson, who's joining us today, began teaching us about monetary policy, things that can go wrong. And at that time, this was 2008 to 2010, the global financial crisis was happening. So we learned, an alphabet soup of terms and terminology about what the Fed was doing. And in a way, in 2023, over a decade later, we've kind of come full circle with the Fed back in the picture. COVID obviously was a big event, but recently with the interest rate hikes and the banking crisis, all of these conversations are back and center, front and center for all of us. So I figured I invite my former professor, Dr. Aaron L. Jackson, at Bentley University to talk about what's going on. He's the Senior Associate Dean of Business at Bentley University right now, served as Professor of Economics there as well, and he was Chair of the Economics Department, focusing on macroeconomics and monetary policy. His publications are in a number of journals, including Applied Economics and the Journal of Macroeconomics, and he provides expert commentary on monetary policy to local and international media as well. So I'm excited for this conversation because I haven't spoken to him in years, and I remember vividly the classes we took on monetary policy and what the Fed was doing. So, Aaron, thank you for taking out the time, and welcome to Pakistonomy.
Thanks, Uzair. I'm really glad to be here. I'm really glad to reconnect with you as well, and happy to have a conversation with your listeners. And as you're talking about this, I'm having flashbacks of the global financial crisis in 2008 and 2009, teaching the course. And I remember vividly, and you may have been in this course at the time, in September of 2008, when the world seemingly was imploding, at least the financial world. I was telling the students to take the textbook and really literally just throw it out the window because that was where we were at that point with with the state of macroeconomics and the knowledge that we had and sort of the stability of the profession and the macroeconomy. And so your comment about sort of coming full circle in some ways is I think highly relevant, but in other maybe perhaps surprising ways, maybe not so much. And I'll elaborate a little bit on what I mean about that. But I think maybe it's useful to take a step back and again go back to sort of the financial crisis and the things that have happened over the last decade or so to maybe help understand a little bit about what we're seeing now today with, as you mentioned, SVB Bank and a few others, Credit Suisse. And are there parallels? What's the connection? How do we get there? So, as I'm sure your listeners are aware, the global financial crisis, it was devastating in financial markets. It was devastating to economies. And we spent pretty much the decade after that. So, you think about the decade from about 2010 to really 2020, right before the crisis, the pandemic started, trying to grow and claw out of the depths of that financial crisis. And through much of that decade, inflation in the U.S. and globally was really low. Along with that, we saw really low interest rates in a lot of countries as well. And so there's a lot of, I think, confounding reasons or connected reasons, I should say, for why that is. There's first, the story about demographics. If you look across the spectrum of most countries in the world, those countries are getting older. The populations are increasingly older on average. Most countries aren't having babies, or at least not at the rate that they were. And so as you see the average age of people getting older people don't buy things, right? They save. and that's how we see this sort of flip in the demographics changing, translating rather into the financial markets, because that sort of created a situation where you had a lot more savings in the global economy than we did before. And so that higher savings through simple supply and demand means that you're going to have lower interest rates as a result of that. More savings means cheaper cost of credit, and that's going to drive down interest rates. So that's one thing that we saw over that period, over that decade period, and we've continued to sort of see some of those factors at play. One of the other major factors that we saw during that period is there was an unusually historically low level of productivity growth. And what that means is that because productivity was low, it makes less sense for companies to invest in capital and equipment and things like that, because the return on that is relatively low. So we didn't see a lot of demand for investment. And so suddenly you get this wedge between supply and demand, which is pushing down.
Which also, to your earlier point, and I vividly remember when in the class you had said throw the textbook out, right, was the basic equation will say if cost of credit goes down, investment should go up because cost of capital is going up, but we haven't seen that. And that has confounded people in terms of saying, well, there's liquidity out there, but we're not seeing real investment demand sort of go up into productivity growth. And that's been, a link to that, how the world has changed, basically.
Yeah, absolutely. So, so we have these factors that are weighing down on interest rates, and in particular, as a monetary economist, we would talk about the neutral real interest rate. So, from a monetary perspective, if you push interest rates above this neutral real rate, then monetary policy becomes restrictive, and that's when you see inflation fall and growth be more restricted. Whereas if you have interest rates fall below that, then monetary policy would be easier. There would be, more impetus for inflation and growth and things like that. But the point of this is that as this neutral real rate has fallen because of the demographic effects, because of the productivity effects, what that means is that it's pushed policy rates globally lower, and in fact closer to what's often referred to as the effective lower bound, right, of zero. So those nominal rates get bumped closer and closer to this zero level. And for much of the decade, as I said, of the 2010 to 20 period, the policy rates in the U.S. were basically at that zero lower bound, or that effective lower bound. So all of this has created a situation where you had really cheap credit conditions, interest rates were relatively low, and oh, by the way, that's also pushed down on longer-term treasuries, the yields on longer-term treasuries. And then you throw in, all the monetary policies that were put into place at the time, aside from policy rates themselves, and I'm thinking specifically about quantitative easing, right? So we saw a number of major central banks around the globe commit to asset purchases on a very large scale. And so in the U.S., the balance sheet ballooned quite dramatically. And what I mean by that is that, if they're purchasing assets on a very, very large scale, then that means that they're injecting money into the banking and broader financial system on a very large scale. So all of that means that we have, a whole lot of money sort of sloshing around in the financial system that's kept rates low, that's been, prima facie has been, there to be able to access for lenders. But for a number of reasons, that money didn't sort of translate into, excessive capital formation and investment and borrowing and things like that. And I think that there's two reasons for that. Again, thinking back to that period between 2010 and 2020, we had all this money in the banking system, but banks weren't lending it out, right? And so there's two basic reasons for why that is, and again, why that didn't translate into more robust growth, more higher inflation, and sort of push longer term interest rates up. One of them is there just was a lack of adequate investment opportunities, right? And this gets back to the productivity growth issue that I mentioned. So banks just didn't see, it profitable to loan out tons of money on a wide scale basis. And then the other thing, as a consequence of the global financial crisis, is that we had much stronger regulatory mechanisms in place. And so specifically, if we think back to what happened with the financial crisis, you had banks holding a lot of lousy assets that ended up being worthless, and that created these cascading effects and systemic effects in the banking system, which collapsed the entire financial system. So the solution to that was that the Fed and policymakers put together a series of strengthened regulatory frameworks that specifically focused on systemic risk, making sure that if a bank is doing something bad and it collapses, it's not going to have knock-on effects in other areas of the financial or broader economy. And so having that stronger regulatory system in place meant that we have these large banks now that are very highly regulated. We put into place these stress tests. So every year, these large banks would go through these exercises, these hypothetical exercises about if there's a shock to the system, how would the assets on the portfolio of these banks, how would that bank respond, survive? How would it have the ability to remain liquid and to function and do the things that are expected of it as a depository institution, right? And so we had much stronger focus on resiliency in the banking and financial system. But a lot of that was really focused on these large, systemically important banks, right? The Bank of Americas, the JP Morgan Chase, right? Wells Fargo, those kinds of banks. But we haven't really been thinking as much about these smaller banks, the regional banks, and whatnot in that process, that regulatory process. So I think all of that is sort of, brought us a little bit to where we're at today in terms of thinking about, what we see with SVB Bank and some of the parallels. One of the things that I want to mention before I get to a couple other pieces of this is that, when we think about the global financial crisis and what happened more recently with SVB and a couple other banks in the U.S. specifically, the amount of lending that we've provided to the banking system is significantly higher just in the last few weeks than it was at the peak of the global financial crisis. So that in and of itself,
even though, as you said, these are small, mid-sized banks, not the too big to fail types that were actually under stress and insolvent and illiquid back in 2008.
That's right. So that in and of itself is sort of remarkable and maybe somewhat alarming, right? The difference, though, is that there doesn't seem to, the banks that we've seen, there's only been a handful of them. SVB is the largest and most well-known of the collapses. These seem to be somewhat isolated incidents. And so they're less connected, and there's very unique circumstances in which we've seen these banks collapse. And so for those reasons, we've seen the Fed and other government policy agencies take notice, but there seems to be less concern, relatively speaking, to the global financial crisis than now than what we saw during the collapse in the financial system.
Before we get to SVB and sort of the hike cycle that the Fed has kicked off, one question I've had in my mind, I've been reading, this comes up in a few articles and analyses as well, from the 2010 to 2020 era, right? That, as you said, older people save more. And so they had more liquidity, more money, but it wasn't translating into real demand growth, which then connects to investments and inflation and all of that. But then some people say that the Fed providing this amount of money, and not just the Fed, the European Central Bank, the United Kingdom, the Japanese, the Chinese, et cetera, mainly meant that we did have inflation, but it was in the form of asset price inflation because the savers are basically buying, they were actually buying financial assets. How do you think about that particular point of view, in the sense that the money was sloshing around, but it ended up going into the stock market, into growth assets, technology startups, and things like that, where valuations, particularly through 2020, went through the roof. And now even that bubble has popped because the rates are now higher.
Yeah, I'll focus on that period around, basically around 2014 to maybe 2017 or 18, because I think that's where um, a lot of this conversation was originally generated, right? The idea that the Fed and the other central banks you mentioned, they were involved in these asset purchase programs. They were pushing huge amounts of liquidity in the system, and all it really seemed to be doing was, for instance, propping up equity markets, right? And so then the question is, well, is that creating bubbles in the system? Is it creating adverse dislocations of capital allocation, right? What I will say to that, and I will put sort of my Fed hat on, my Federal Reserve hat on, and say that the Fed can do only so much with the tools that it has, and in the case of the Fed, their almost sole interest was based upon the mandate, which is maximum employment and stable prices. So in other words, we want to keep unemployment relatively low, and we also want to keep inflation at a stable level, right? And so the whole purpose of it was to essentially create inflation as defined by the core PCE inflation index. That's the main indicator that they look at, right? And it was recognized, I think, in a lot of ways that there would be, some potential secondary effects, like, have escalation in asset prices, which we did see, right? But the counterfactual to that is what's, I think, important to think about, is that if the Fed didn't do those things, then how much longer would it take for the economy to get back to a baseline, right? Back to full employment and back to inflation at a reasonable level. Again, it took until essentially the pandemic, where we had this extreme dislocation of labor and capital, for inflation to finally come up above 2%.
And that's
It
what also
literally,
people do say, right? Is that the Fed actually, as you also gave a data point, has provided more capital in the last few days and weeks than it did at the height of the GFC. And that was the criticism, that both the Fed and Washington, the Hill here where I live, moved far too slow to deal with the crisis that occurred, and basically led to a lost decade, essentially, in terms of growth of jobs and economy, and really providing relief and income growth to people who had been really devastated by that crisis. And so we come to the pandemic, and they unleash, both on the fiscal side as well as on the monetary policy side, a huge amount of money into the economy. Then we have, obviously, under the Biden administration, the Inflation Reduction Act, and money going into sort of diversifying supply chains and things like that. So the government forcing that investment demand to come through, basically, which wasn't for the last decade or so. Basically, I think you would agree then that the lesson learned of the GFC then was that we actually should move faster, do more in the pandemic, because otherwise the devastation, you cannot afford another lost decade, essentially.
yeah, that's exactly the lesson that I think the Fed took. To give you some a stark sort of example of this, in that period, in that March period of 2020, the Fed had a regularly scheduled meeting. I can't remember the exact date, but it was on a Wednesday, and the the scale of the problem escalated so quickly that the Fed actually decided to meet on the Sunday before that regularly scheduled meeting to prescribe a whole number of things that it was going to do. precisely because it was worried that the next day, that Monday, when financial markets open, it could really create a collapse in the system. And so the point of that is that I think the Federal Reserve and many other central banks around the world have learned to be a lot more flexible based upon sort of the playbook of what happened in the global financial crisis. Give you another example. With again coming fast forward to today with the SVB and the banking challenges, the Fed created this new facility called the Bank Term Funding Facility. Essentially, it's a form of a discount window where banks that have decent collateral, they can borrow against that if they have liquidity constraints. And so the ability of the Fed to create these facilities and use them in targeted ways is much more dramatically impactful now than it was even during the financial crisis, certainly before that.
And that obviously is saving contagion to set into the system, which we'll get to in just a moment. But now we are in this situation where obviously inflation is back. People keep talking about in the mainstream media about the 70s and then, a lot of money sloshing around, and we're going into this era of hyperinflation and too much dollar, and this is the end of the dollar's era as the reserve currency, blah, blah, blah. You name it, you'll find an analysis starting with too much money in the system and going all the way to like Germany and hyperinflation is around the corner type of views at the very extreme. How do you see this return of inflation and the way in which the Fed has stepped up in terms of hiking rates and both the intended and unintended consequences of that, right? Because going back to your original point on demographics, for example, we see that the jobs market is still red hot. And obviously, folks like Paul Krugman and others have said, well, that's actually happening because we're aging. And so people are dropping off of the labor force. So it's actually becoming more complicated to cool the job side of the equation down and wages to cool down because there just isn't enough labor in the market. And oh, by the way, we're also investing now a whole lot more. So how do you see the Fed's reaction to all of this now? Because on the one end, we see people saying, well, they need to act more. And on the other, we have people saying, well, they should have actually not even done the last 25 basis points hike because we see flashing signs in the economy.
Yeah. So in a note to a client, I do some consulting on the side. I had indicated that I thought that the Fed would do a 25 basis point increase. Now, my reasoning for that was, I think, basically sort of splitting the difference of what you're sort of alluding to as these different sort of sides of the camp. The Fed for the last couple of months has suddenly been very concerned about inflation flaring back up. So to your point, going back to the roaring 70s with inflation, if the Fed doesn't stay ahead of that, then that could continue to create this persistent inflationary problem. So up until a couple of weeks ago, the Fed seemed pretty well set to raise by 50 basis points, right? So then we have this, this banking crisis that comes along. I hesitate to use the term crisis because, again, it's at this point we've seen it as an isolated incident of a few banks, right? But we've had this banking situation pop up. There's clearly some problems in the financial sector in certain areas, and that's likely to have the effect of a financial tightening in the banking and financial system, right? And so what that means, and Jay Powell alluded to this in his press conference following the last Fed meeting on Wednesday, that that in and of itself could create what would in effect be a policy tightening without having to change the Fed funds rate, for instance, right? The main policy interest rate. So that's sort of where I'm thinking about it. And then again, the inflation problem is still there. If you look at the data, inflation is coming down in the U.S., but it's coming down very, very sort of at a slow rate, I think. Certainly much slower than you would want it to if the goal is to be at 2%. I think we would be lucky to get to 3% by the end of next year, the end of 2024, based upon all the things that were happening that we're doing on the policy side. And then if you look at, for instance, the UK, their inflation is still at 10%, right? It's really high, and they're in the mode of more tightening and more policy um, constraints. And the one other thing that I would add to this, I think, very complicated puzzle is that this inflation thing is global, right? If you look at all the major large countries, globally competitive countries in the world, they all face this inflation issue, right? So it's not necessarily something that the Fed has created or not created. It's not necessarily solely because of U.S. fiscal policy and the massive amount of spending that's happened. Again, that might be a contributing factor, but it's not the single factor or a very large factor, right? It's these global effects that are now related to the pandemic, the dislocation of capital and labor, the disruption of supply chain that really escalated input costs, as well as you mentioned before, the wage increases, like the effect of wage pass through to higher inflation. We've seen that's been really substantial in this inflation story, and that's one of the reasons. Although the supply chain stuff and the global commodities and inputs story has, I think, uh, has come down a little bit in terms of the inflation story. The wage growth is still pretty hot. That's what the Fed is worried about. And again, to your point, these demographic things really aren't going away. So that wage growth thing seems to be something that's probably going to persist, which means we're probably going to have that sustained pass through of inflation. So even if we have contractionary policy, even if we have appropriate contractionary policy, it's going to take some time to bring that down under the best of circumstances.
Yeah.
Right?
And I think,
and then so that's the reason why I would say, not doing anything, in other words, holding rates in light of what's happened in the banking system in this last meeting, I think would not be wise, because it would do two things. It would signal that the Fed thinks there's a larger problem in the banking financial system than maybe there is, right? It would also signal that maybe it's not committed to that decline in inflation to that 2% goal, which again that could end up creating much bigger problems of credibility down the line.
yeah, and I think linked to that whole 10-year capital dislocation, essentially, right, is what we are beginning to see. For example, Pakistan, a country we often talk about on this podcast, or Ghana, or Ecuador, and Egypt, and other places, is the Fed is raising rates, which is making capital for them much, much more expensive. At the same time, input costs for commodities and imported commodities has gone up. So the currencies are under pressure. And the currencies, that causes a double whammy effect on inflation. So you're seeing inflation run amok in a place like Pakistan at 35-40%. And this is why people are interested, well, what is the Fed doing? Because the reach for yield era, as I keep telling folks, is over in sort of the global system. So you got to adjust. And so debt restructuring becomes a problem. Access to the bond market becomes a problem, all of that stuff. But looking at more domestically here with Silicon Valley Bank, and you said, for now, it seems like a bunch of isolated incidents. What we saw, at least from the coverage over here, was that it essentially was a bank that had taken short-term liabilities and used that to buy long-term assets in the treasury market, and basically was misplaced in the way it thought about rates going up. And oh, by the way, under the Trump administration, some regulations were made easier, which meant that they were not exposed to the same type of stress tests a JP Morgan or a Wells Fargo or a Bank of America would have been exposed to. So how did you then see sort of what happened over the last few weeks and what is still going through the banking system right now? Like, is this just limited to the fact that you had long tenor treasuries on your balance sheet that you were mispriced out of? And so that adjustment has to happen. And so the Fed has stepped up. Or are there things that at least you're watching and keeping an eye on to see and follow whether this is more than just a few isolated banks in America?
Yeah, that's really the $1 million question. I'm gonna reverse back to the financial crisis. If you remember, and maybe some other folks listening remember, in the spring of 2008, Bear Stearns, which is one of the oldest investment banks in the United States, they collapsed. And the Fed intervened, and there was some government intervention that was done. It went away, but it was bought by another company. That seemed to be a sort of isolated incident, because again, at the time, inflation was still rising relatively rapidly, because of energy and fuel costs primarily, right? And so again, you have this weird confluence. At that time of inflation was relatively strong. We had this flip of Bear Stearns collapsing. We took care of it. We thought, there wasn't necessarily any other issues. And then you fast forward to September of 2008, and the financial system implodes, right?
By the way, I remember that day in the Bentley Library cafeteria watching one of the four screens where basically it was flashing red, and like that day is like etched in my memory as a student.
Yeah. So I don't want to say that, it's isolated and we don't have anything to worry about and everything is great, right? Because Bear Stearns is an example of where we thought that. And maybe, I don't remember what I thought about it at the time because that was a long time ago, but other folks might have said, "Oh, this is just a harbinger of things to come," right? So my point is that we just need to be careful about dismissing this altogether. Having said that, there is some reasons I think to believe that this is a somewhat more isolated set of circumstances than what we had in the financial crisis. From a big picture perspective, the Fed can still raise policy interest rates to help tighten monetary policy and bring inflation down while still providing targeted liquidity to banks that really need it, right? So if there are other banks that pop up that get into this situation, then the Fed can intervene and sort of use both of these tools simultaneously to achieve sort of different objectives, right? So that's a good thing.
And
again, we have a bigger
stream of consciousness thought on this before I forget was the Fed's own origin story, right, is an institution to deal with banking crises, and it was built up to prevent that from happening. So there's a legacy. We now think of the Fed as inflation and employment, which is its mandate, but originally the idea was to prevent exactly the situations that you're describing from happening.
Yeah, that's the whole reason why central banks exist, right? To prevent bank runs and collapses in the banking and financial system. And so that's the history of central banking. And so you have this situation where, from a broader perspective, the Fed has these tools that it can deal with sort of independently to help banks if there's problems, and they can also tighten policy if needed. With SVB, and again, this is one of the reasons why I think it's a little bit more isolated than what we saw with SVB. There's two keys to what happened there. So you had this smaller or regional sized bank, although it's the 16th largest bank in the country. So that sounds like it makes it large, but we've had a significant amount of consolidation in the banking system. So the size of the top 10 banks, the market share of those top 10 banks today is vastly more than the market share of, say, the largest 10 banks 20 or 30 years ago, right? So what that means is when I say it's the 16th largest bank in the country, well, that might have meant something 30 years ago, but it doesn't mean as much today. So what about SVB? They were an outlier in terms of the percentage of uninsured deposits that it had, right? And so what that means is that you have basically a lot of high net worth individuals. You mentioned startups, right? So they were using SVB as a bank for their operations, and they have over the $250,000 insured limit, right? So you have small businesses that often have money in the bank above those limits. So it had an unusually large amount of balances above the insured limit of 250,000. And as you mentioned, it had a significant holdings of long duration treasuries, right? And those two things put together in this higher interest rate environment means that when long rates went up, of course, the value of those treasuries fell, which then makes the assets on the balance sheet worth less. Now, the ironic part about this is that we think about treasuries as the safe risk-free asset, right? So if a bank is holding treasuries as part of their portfolio of assets, what's the problem, right? Well, the problem is, in some sense, they became highly illiquid because you had this sort of gentle increase in longer rates, which ended up being much more pronounced over the last few months. And what that meant is that the value of those treasuries to the bank, well, in terms of collateral, they would be less, right? If they had to sell them on the open market, they would take capital losses. And so that's what depositors were seeing. That's what analysts were seeing. Now, if the bank just held those assets to maturity, there would be no capital losses. Well, if they do that, then that means those assets are not liquid, right? So that's where we've seen some of these banks get into trouble, is that even though we think of treasuries as liquid assets, with that acceleration in rates and the decline in bond prices, you either take capital losses to sell them to get liquidity, or you hold on to them, in which case they're illiquid. And that's
Also,
exactly what we saw.
Connected to that also was the fact also that, right, that we heard about sort of the Silicon Valley tech bro community being on the same groups and Discord channels, et cetera, saying, take your money out. If that had not happened, it was a classic bank run. If that had not happened, they wouldn't have had to take those losses and be insolvent / illiquid at that point in time as well.
Yeah, that's a really great point. I'm glad you mentioned that, because if we think about a good old fashioned bank run, it's, you see a line of 4 or 5 people outside of a bank, and then you call your cousin and say, hey, don't you have a bank account there? Like, maybe there's something wrong. And then they go, and now with social media, that was driving a lot of it, is exactly what you mentioned. There's a small group of people that had large sums of money in these banks, and they all talked to each other, and they said, you know what, this doesn't look right, we need to get out. And so within a matter of hours, there was billions of dollars being withdrawn from the bank. And so that created this really, really sharp need to inject liquidity into SVB Bank. And part of the other aspect of this, which really makes it unique, is that a lot of this, the most virulent part of it happened later in the afternoon on a Friday. And so the bank's ability to access normal channels of capital through the Federal Reserve System, the FDIC, and other affiliated bank liquidity facilities, it was much more limited because of the markets were closed on the East Coast, some of the offices and operations that would take place in interface with East Coast time, they just weren't available. And the speed killed it, right? The speed of that deposit outflow, along with the lack of the bank's ability to get funding and liquidity in short order, that those two things really were the linchpin there.
Yeah, and I think it's the technology-enabled classic bank run that we saw. And in fact, if you had kept your money there, not been part of it, you're on average fine. But there were, again, I was speaking with a venture capitalist out of the Valley, and he was saying and sharing about how all of a sudden now they're reading macro reports and treasury patterns and things like that to understand exactly to your point, right? Typically, people would say, well, you're holding treasuries; those are safe. I don't need to worry about it. Turns out you kind of do have to pay attention to the mix of the treasuries that you're holding on your balance sheet. And now people are waking up to that new fact as well. And so we'll continue seeing, what other banks have exposure on that side. The one other thing I wanted to get your take on was, we saw Secretary of the Treasury, Yellen, make some points about how much they will provide coverage, and then she sort of changed her tune a little bit over the last week as well. What have you made of the response outside of the Fed, particularly from the Treasury side, in terms of what they're willing to do? Because again, I've sort of been reading and been hearing two arguments. One is the classic moral hazard argument that if you bail them out, the expectation is it happens again, to which my point at least is, well, this crisis is not due to bad habits. It's just a asset liability mismatch that has happened in the short term. But then the other side of the argument, the more insurance oriented people I've been listening to are arguing, well, this is the whole thing. If you don't provide insurance and sort of a floor early on, then the contagion will mean you will intervene 3, 4, 5 months down the road with a lot more losses. So where do you stand, and how do you see that debate that's going on the Treasury side of the conversation?
Yeah, that's a really great question, and I was going to actually kind of get to that. Let me go back to SVB, right? Here you have a bank that, all else equal, seems perfectly healthy, right? They got a lot of deposits. They're the 16th largest bank in the country. All of their assets are safe, right? Agency mortgage-backed securities, which are highly rated, treasuries, again, risk-free, and they have access to liquidity facilities at the Fed, right? Up until the Thursday or whatever it was when all of that started to snowball, it looked like a perfectly healthy bank. Sideline to that, I think it was very poorly managed, because the point that you sort of alluded to is that we could have seen this increase in interest rates coming, right? The increase in treasury rates. And so a prudent bank manager and portfolio manager would recognize that, well, with tighter policy, inflation persisting, that's going to lead to higher long rates, and that's going to adversely impact our portfolio. So we need to hedge our risk. They didn't hedge any of that, right? They didn't adjust their portfolio or do anything. And so that signals that there's a larger problem there, right? The bank management problem. But aside from that, right, think about the optics. Again, you have a perfectly healthy bank and a perfectly healthy economy. Suddenly they collapse. Now, if we only insure, up to the $250,000 limit of this bank, what's going to be the perception of the public, from other depositors in small regional banks, right? How is that going to play out? It's likely that people are going to look at that and be like, wow, we thought this bank was healthy. It collapsed. I'm going to go to my bank and take my money out, because that's probably, that's got to be vulnerable too, right? So that's the thinking, I think, of the Fed and the Treasury and the FDIC, is that if we don't go in and forcefully, make them whole, even if these are high net worth individuals, right? It's not about Signature Bank. It's not about bailing out depositors or Signature Bank or the investors of that bank. It's about strengthening or maintaining stability in the broader banking system specifically. So that's why they acted to insure all of the deposits of those bank deposits at SVB. I think it's Signature and a couple others maybe. So with that, you mentioned the discussion of Janet Yellen at the Treasury and possibly the FDIC having a blanket wholesale insurance of all deposits in the banking system. First of all, from what I understand, that was something that she sort of presented as a potential option, but was never really intended to be a formal policy prescription, right? And I think she's also sort of walked that back a little bit.
As of, I think, yesterday in her comments, she mirrored her earlier remarks, but then changed a few words here and there, which, again, I know from your class, you got to read every single word, and it changes over time to know where the policymaker or the official is going with this.
Yeah. And so to your point, it would be a very dangerous precedent from a moral hazard standpoint to simply blanket insure all banks' deposits at this point. First of all, it would be incredibly expensive to do, right? The money has to come from somewhere. So it either comes from the fees that banks pay into the FDIC to support that insurance program, or it comes from taxpayers, right? Either way, the money has to come from somewhere. And that would be really expensive to insure the literally dozens of trillions of dollars of deposits in the US banking system, right?
And I think the fiscal side of it, just really quickly, would then become a political problem because this is north of $250,000. So a lot of individuals going to their congressmen and women and their senators would say, why are you taxing me and using my taxpayer money to bail out and provide guarantees and insurance to people who owe 10, 50, 30, 40 times more money than I do in the bank? Like, this is not
So
fair, and that
it's
becomes a
definitely
problem.
a political problem, right? It's a problem of moral hazard, which we saw very clearly in the financial crisis. It needs to be a break on bad behavior, right? And then the related aspect of this, though, I think is, does it make sense to reevaluate the $250,000 limit? Probably, right? It's been since 2008 since we reevaluated that. Prices have probably just about doubled since then. The general price level, the amount of deposits in the banking system is, I don't know what it is. It's probably like tripled or quadrupled. So if you look at some of those benchmarks and think about what's the appropriate level for the insured amount of deposits in an account, it probably should be more than 250. Maybe it's 500,000, right? So I think certainly the FDIC will probably look at this. It's not something that will necessarily happen overnight unless we have more virulent, banking crises that pop out of this. But I think it's the limit is something that is going to be evaluated. And then the other thing that I think we're really likely to see is much more scrutiny on the regional banking side, right? Stronger regulatory oversight. Again, the ironic part about this is twofold. We had the financial crisis, which was caused by a bunch of large banks that are systemically important. They collapsed the entire financial system. So what did we do? We created a whole system of regulations to ensure that those large banks are not going to be in a position to cripple and collapse the financial system, right? So we were paying attention to these big banks. We forgot about these regional and smaller banks because, well, they're not systemically important, right? They're just banks. We can insure them. And oh, by the way, they have all of these safe assets, right? Well, they're not really safe, and we just learned that under somewhat unusual circumstances, they can, really do in a bank. So now we probably have to rethink the regulatory lens of these smaller banks, the ones that don't fall under the systemically important large banking lens, and think about, what's the impact in the banking system for those folks, and think about what are the assets on the balance sheet, what's the risk, does it have these maturity mismatches that you alluded to that created some of the problems with liquidity with SVB, right? What's the appropriate level of oversight, and how does that translate into the broader banking and financial system?
Yeah, I think there's lots up in the air on that. And I think in a polarized environment here in Washington, it's going to be at least interesting to see how the debate moves forward, right? I saw Senator Warren coming at the Fed for raising rates too quickly as well, which, when I put my Pakistani economy hat on, I'm like, well, policymakers in Washington and Islamabad are pretty much the same. They love low interest rates and don't want the Fed to do what it should do to stabilize the economy and the financial system. But we'll keep an eye out on that. Before, last couple of questions I had for you, would love recommendations from you on books or things people should read or follow to learn more about these topics. And connected to that also is, what are you on the lookout for in the, let's say, next 8, 12, 16 weeks as this thing moves forward, right? Again, as you said, Bear Stearns, many thought was just a blip, and Lehman followed soon thereafter. So if you're sort of following that kind of trajectory, like the Bear Stearns type event has happened, and hopefully it doesn't lead to a Lehman, but what should people be watching out for to sort of continue monitoring this situation? And then what would you recommend they read?
I'll answer the what do we look out for first. So you know, I don't think that we're going to see that repeat of the Bear Stearns turning into Lehman part, right? Again, because we've learned so much from the financial crisis. The Fed has learned so much. Policymakers have learned so much about monitoring and you know, the need for swift policy action, you know, where appropriate. And so if we do, you know, see some of these blips, I think the Fed is going to take very forceful action to make sure that the banking system is supported. You know, to give you just a quick sort of example of this, I mean, that new banking facility that I mentioned, the bank term funding facility, on March 15th, there was about $12 billion of uptake in that facility, the lending facility. The week after that, so this is yesterday, it was reported that there's almost $54 billion of lending that's running through that facility. So just in that 1 week, in this last week, there's been you know, over $30 billion extended to banks through that facility. The overall amount of borrowing from the Fed in March 8th, it was about $4 billion. And if you look at the numbers prior to that, it bounces around 3-4 billion, 5 billion, somewhere in there, right? It's flatlined. And then we get to March 15th, it's 143 billion. And March 22nd, it's almost $300 billion.
Wow.
Right. So it increases quite dramatically. So my point is that I think that the Fed, again, is going to be highly proactive in making sure that the banking system is resilient. And so that's why I don't think, now we might see some of these banks, again, pop up here and there, but I think it's going to be something that the Fed is going to be able to deal with more proactively to ensure it doesn't create a really big problem in the financial system and the banking sector. So, you know, it's entirely possible. I don't think this is the base case, but it's entirely possible 6 months from now, again, we could look at the banking system and say it's really well capitalized. There's no, you know, there doesn't seem to be any inherent risk. And oh, by the way, inflation is still really pretty strong. And the Fed might keep pushing the policy rate up because inflation, right? Not because of this banking stuff. You know, I think the base case, though, is that, you know, the Fed is probably potentially going to raise policy rates one more time and then hold it there and just sort of see what happens, right? Or maybe it doesn't raise at all, and we're just sort of at the point where it's going to wait and see. It all really depends a lot on how the financial tightening in the banking system works its way through, based upon the, you know, the ripples that we've seen in these few cases. So that's where I'm at, I think, with policy. To answer your question about books, you asked me, you know, what books do I read? I don't actually read books, and that might sound a little silly being an academic, but I don't find time to actually be able to read books. You know, I'll give you the list of stuff that I read, which is the Wall Street Journal. I read it religiously every day, and that's where I get a lot of my information. And then I read kids' books to my 2-year-old and my 4.5-year-old.
Well, that's a priority these days. So yeah,
yeah,
that makes sense.
these
So you
days
do read books. You read kids' books.
Yeah. You know, so that's sort of where I'm at in my literary world.
Yeah, I'm more partial to Bloomberg these days than the Journal. But yeah, if you read either or one of them, and then maybe add on The Economist every once in a while, I think that's a really solid source of information. But Professor Jackson, thank you so much for taking out the time. This was a wonderful and enlightening conversation. I always have learned a lot from listening to you, and years later, that's still the case. So thank you. And we'll keep an eye out on what keeps happening. And hopefully this is just a blip. It's not the financial crisis that you went through as a professor at Bentley and I went through as your student. And you know, it was crazy times. I still remind young graduates coming out that, in our econ class, I graduated 2010, 2009, I think out of 45 or some econ grads at Bentley, maybe 2 or 3 had jobs. And out of my year, maybe 10 did. And that's not a position anybody wants to be in. So hopefully it doesn't come to that. And the Fed and the policymakers, not just in the US, but around the world, proactively deal with whatever blips there are on the horizon. So again, thank you. Much appreciated.
Of course, it was there. It's really great to connect with you again, and yeah, I'm delighted to talk about this stuff. So thank you for the opportunity.